Hi, it's Robert Mendelson, Fractional CMO here in beautiful Montreal, welcoming you to another episode of the Fractional Pros Canada podcast. We're part of Fractional Pros Canada, the home for Canada's fractional community, and you can find us on Facebook. We bring you conversations about everything fractional that matters for fractional executives and businesses from coast to coast. Think of this as your go-to spot for real talk, practical wisdom, and strategies you can actually use, all without the corporate fluff and with plenty of Canadian content. Whether you're a fractional pro or a business in our great country of Canada and beyond, this conversation is for you. Grab your espresso and let's dive in. Welcome to the Fractional Pros Canada podcast. I'm your host and fractional CMO, Robert Mendelson, here in beautiful Montreal. And just down the street from Toronto is Marc Racette. Marc is a recognized expert in cross-border payments who has spent nearly a decade helping businesses navigate the volatile world of foreign exchange. He's the co-founder and CEO of Pulse FX, where he's on a mission to help companies take control of their international payments. He was recently named the 2025 Emerging Leader by The Peak and holds a master's in global affairs from the Monk School. His goal is simply to stop businesses from losing money on foreign exchange without even realizing it. Today's Fractional Pros Canada podcast, powered by YourCMO.ai, streamline your marketing and business processes with AI-powered automation tools that are tied to your CMO's proven process for predictable growth. You can learn more at YourCMO.ai. That's YORCMO.ai. So, Marc, welcome to the pod. We have much to discuss.
Yeah, thanks again for having me today.
And we need to start off by telling everyone the story about how we met. So Marc and I bumped into each other outside a private holiday party a couple of weeks ago in Toronto, and we were there on time. We were the first two guys there on time, and the door to get in was locked. And it's funny because, Marc, your work is all about access in a way, right? Access to better rates and global markets, but there we were, you and I, stuck with no access on the sidewalk.
Great opportunity to start a conversation, but otherwise, not ideal.
All right. Well, Wilson and Jonathan will, a shout out to them, the guys who were throwing a great party as it turned out to be. And next year, if we get invited back, hopefully they'll start on time.
Yeah, let's hope.
All right, we're going to get messages on that. All right. So anyway, once we did get inside, started talking, and I realized what you do. I realized this is exactly what, fractional CFOs and COOs need to know about, as well as business leaders. There's a lot of things that I found out from you that I did not know. So I want to dive into all of that. But before we do, you spent time working in Shanghai and Taipei as a researcher for a while before you moved into finance. And I'm curious about what your experience was living in those major Asian hubs, and how do you think that experience shaped your view on global currency and trade and what you do today?
Yeah, I mean, so we're going back quite a few years ago on those, but truly amazing experiences to see, how business is done, how, there's cultural differences between Canada and the rest of the world in a great many of ways. One of the first few things I learned in China and also in Taiwan is just, the reliance on relationships and making sure you maintain and continue to build relationships when it comes to business. There's so much more emphasis put on that, and so much more time and effort goes into making worthwhile connections, I feel, than I would say events in Canada. I mean, from a networking perspective, right? We've all been there. We go to a networking event, there's 100 people, and you're trying to make your way through a room and hopefully try to talk to everyone, which unfortunately leads to 1-minute conversations where it's like, this is what you do, great, okay, here's my business card, moving on. There you actually spend time getting 20-30 questions from someone. They really want to know the ins and outs of what you do, and that really stuck with me, and it's something I carried back, and it's probably been one of the keys to my success here in Canada, I should say. But a lot of interesting learnings from that trip. my role in that capacity was predominantly helping Canadian businesses learn the lay of the land in both areas. So understanding what's required to do business in China and Taiwan from could be a legal perspective, from a manufacturing perspective, from just trying to find partners to expand your business, you name it. A lot of interesting learnings that ultimately kind of led to where I am today and the knowledge I have at this point in time.
So when you and I started talking, one of the first things that I learned from you that I was like, what? One of those what moments was that as a business owner myself, I always assumed that if I needed to get a US bank account, that I could just walk into a bank here and open one. But the day I needed to do that, I found out that actually it's not that easy and it's not really how it works. And it took me a while to figure out how to even get a USD credit card with a Canadian bank. And even then, to this day, I have no control over how I pay that card. It took me hours of phone calls and back and forths to figure out that the only way I could pay off that balance on my USD credit card with a Canadian bank with USD dollars was to set up automatic payments monthly from my USD account, which is working okay, but like is not ideal. And so you confirmed to me that for a Canadian entity, it is actually nearly impossible to do these kinds of things. But you said a company like yours can make it happen. And that's where I was like, what? There's another option, which I had no idea about. So tell us a little bit more about that. Share that with us, because I think there's a lot of business owners who don't know about this door number 3 option.
Yeah, no, for sure. I mean, there's a lot more to foreign exchange than just getting a good rate. There's a lot of interesting products that now exist in the market that can go a long way. The one we were specifically talking about is what's called a virtual IBAN. IBAN is essentially a bank account. These accounts are essentially meant for receivables and payables. So unlike a traditional physical bank account, you wouldn't, for instance, go into a bank and be able to withdraw cash, or you wouldn't be able to get, a mortgage or a line of credit on these accounts necessarily. But for any sort of outbound or inbound payment, they work wonders. Depending on what partners you might have in terms of banking relationships. Some banks can provide these mostly to U.S. clients. Unfortunately, the Canadian banking sector is still a bit behind on the technology side of things, but these accounts can be created, at least on our end, for Canadian entities in over 30 different currencies. So we were talking about the use case of a US dollar account, but honestly, we can do British pound, Swiss franc, Japanese yen, euros, you name it. Top 30 trading partners of Canada, we typically have access to create these accounts, which wouldn't even be possible at all with a Canadian bank. At most, you'll have the ability to create a US dollar account in addition, obviously, to your Canadian account. But as you indicated, sometimes you have to go through quite a bit of paperwork. It could take potentially months to get that set up, and there's fees associated. But these accounts, once more, don't have any sort of fee associated. They take about a day to set up, and they can be easily deployed and connected to a variety of services. So whether you use them to collect U.S. payments and then use those funds to pay off a U.S. dollar credit card, they can be connected to any sort of payment processor. So if you're as a Canadian business, let's just say selling your service or product, and you're using Stripe to collect payments, or you're using Square or PayPal, you name it, you can essentially connect these accounts to those systems so that when funds arrive, you can have them ported over to, let's just say, your US account, rather than having those systems auto convert to Canadian. And the interesting thing here is, even when it comes to these payment processors, even though you might also have a US dollar account in Canada, they won't necessarily let you move funds from your US holdings with them to a US dollar account in Canada. And that's largely because these systems have housed in the U.S. and are mainly operated via U.S. banks. So unless you have a U.S. bank yourself, which is what we would create with a virtual IBAN, in this particular case, it'd be Citibank, you would be those systems would be forced to do a traditional wire to pay your US dollar account, compared to a US bank to US bank transfer, also known as an ACH, which is a free form of payment. And that's what these systems ultimately prefer, because otherwise, as big as Stripe is, they are going to get charged a wire fee if they have to move your US funds from their balance to your US dollar account here. So there's no money in it for them. So they'll force typically the conversion, unless, some of these systems, honestly, they do have a much higher tier plan where you're paying hundreds of dollars a month for that ability. But it doesn't make sense when you think about the alternative options in the market. You can be paying hundreds a month, or you could just open up a virtual IBAN account, have the funds move there, and just do the conversion yourself, or have the ability to repurpose those funds. So a lot of use cases to these accounts. I should say they don't just work with payment processors; they work with payment gateways. So you look at Shopify, Amazon, Faire, any of these e-commerce platforms. Same situation. If you're generating revenue in a certain market, you really want to be able to collect those funds into an account with that domestic currency. So you yourself are able to either repurpose those funds for, let's just say, you might have marketing expenses in those countries, or to do the conversion back to CAD. Because if you use these systems, they're not foreign exchange platforms. They're going to charge you, typically 3.5%, 4.5% on top of whatever additional fee they might have just for collecting your funds. There's a lot of opportunity there, depending on what your sales are. This could be thousands of dollars you're losing out on a monthly basis, and that's where virtual IBANs come in.
All right, so it's my word of the day: virtual IBAN. Put it on a T-shirt, get it on the ball cap. All right, if I'm a fractional CFO, often one of the things that I'd be hired to do is to find efficiencies, stop the bleeding, right? Cut expenses that are unnecessary, and you've mentioned that traditional banks often hide fees in the spread, that famous, in quotes, spread, right? The difference between the buy and the sell rate. And if a fractional CFO is walking into a new client, let's say tomorrow, what do you think, what would you recommend is the audit that they should be running from that perspective to try and catch any efficiencies that they can identify there? They need to look at a bank statement? Is there a way to instantly tell if the client is getting ripped off or paying too much? What's the best course of action there?
Yeah, for sure. So when I can break that down on like a payment platform level and a bank level. So payment platforms are actually transparent with their pricing wall. I mean, transparent in that it's in the finer details, that 20-page document of terms and conditions. You'll typically see
that nobody reads.
Which no one reads, exactly. But you'll typically see in there, 3.5% roughly, markup plus this fee. So that's something that immediately you can jump on as an opportunity if you have a client using those systems. There's an immediate opportunity to save money. When it comes to banks, banks are a little less transparent. Typically, they'll base pricing on a wide range of factors depending on the age of the business, if you have multiple products with the bank, if you're considered a higher risk, lower risk industry. There's a lot that goes into what their pricing is, and sometimes I honestly wonder if it's if your friend works there, maybe they can work wonders. I've seen some crazy different spreads. I've seen someone, for instance, moving $5,000 getting half a cent spread. I've seen someone moving $3 million getting close to 2.5% spread.
Wow.
So sometimes it's not just about moving a higher amount and getting a better rate. Sometimes it's depending on if someone's willing to budge on a bank level, or if you're willing to try to find grounds for negotiation on some items. But most of the time, foreign exchange is a bit of an afterthought, especially during the application process with many banks. So I find most accounts, unless you've negotiated at some point or another, you're typically looking at, I would say, 1.5 to 3.5% upcharge in terms of their spreads. Now, in terms of doing an analysis, one of the things I sometimes recommend is if you have access to like a mid-market rate, which is, it's more of an indicative rate. It's the average between a buy and a sell. So that's what you would find if you go to Google, for example. If you go to, Google, type in, CAD to US rate, you might see something like, 1.38, for example. Generally, if you're anywhere around, like I would say within 2% out of that rate, you're generally, in a higher tier or a higher spread bracket with a bank. So that's something you can look at potentially either negotiating with the bank or finding an alternative, foreign exchange broker to kind of help reduce those costs. More often than not, if you have the ability to pull a rate from your online platform, you can check in to what your rate might be and then kind of compare it to that number. Once more, but that's more like a little bit of an indicative number rather than a true buy or sell number. I always recommend just doing a comparison with some form of brokerage as well too. Just seeing what's possible. It's like most things. I mean, if you're going to get a mortgage, once more, you should probably shop that around every once in a while just to see what's possible. Rather than just going with the very first offer you get. Foreign exchange is one of those areas that you might be honestly surprised to see what's possible in the market. But yeah, it's my 2 cents worth in that.
So shopping around, just like anything else, makes sense. But it sounds like if you can cozy up to your bank manager or whoever that person is that owns the bank relationship for you, that they have some flexibility to kind of be a little bit nicer to you as far as the rate goes. And it's just, it's just comes down to like, is there any secrets, anything that you've seen that works? Is there anything to say to them? I know, like, for example, if I'm not happy with my cell phone plan, I call them up. And the first thing I say is I want to cancel. They send me over to the a client retention department, and they're the ones who could give me the best possible deal. Any kind of tips like that when it comes to finding a better rate with a bank?
Yeah, I mean, sometimes it could be as easy as that, just calling them up saying, hey, I'm talking to Marc Racette over at Pulse FX, and, he's saying he can do this. Do you guys want my business or not? Sometimes it's as easy as that. Although you'd be surprised, sometimes I've literally had people go to the bank and try and negotiate, and that their point of contact or whoever's in charge of their account has literally said you should actually be looking elsewhere. So I've had that happen many times. I always try to figure out who that person is because I always try to befriend them because those are great honest points of contact.
Honesty is rare these days with on that side of the table.
No, for sure, but it's all over the place. I can tell you, Robert. I mean, I've seen times where people have been able to get better rates. I've seen times where they have, but for a short period of time. So the banks kind of drop their rates for, 1 month, 2 months, 3 months, and then next thing you know, it's back up again. I've had times where the banks also just said, yeah, no, sorry, can't help you. Yeah, if you want better, go somewhere else. So,
do you think we're at a disadvantage here in Canada because we have so few banks? Is it a different story south of the border?
Yeah, 100%. When it comes to the banking climate in Canada versus the US, I mean, we don't have open banking here. It's cumbersome to move from, one bank to another here. There's limitations in terms of product offerings, like case in point, virtual IBANs, just not a thing here. So yeah, I would say we are somewhat disadvantaged. I mean, don't get me wrong, there is some advantages to our banking system. Just, the additional regulation does help protect, assets and funds and all that. But when it comes to product offering, yeah, there's really a shortage of innovative ideas and, flexibility, I would say, in the Canadian banking sector. That being said, interestingly enough, foreign exchange is something that just remains niche on both sides of the border. Despite even the U.S. having 3,000, 4,000 different banks, because even the U.S. dollar is the global currency of the world. there's very little U.S. businesses actually still engaged in significant FX flows, and typically when they are, they typically see even higher spreads than here, uh, especially when you see the breakdown of a municipal bank, a regional bank, and a national bank. A little tidbit: sometimes I've seen a client working with a municipal bank that doesn't even do foreign exchange. They
Hmm.
have to go to a regional bank to get their rates. And sometimes that regional bank might not even do foreign exchange. So they go up all the way to a national bank, in which case you're getting spread on spread on spread all the way
Everybody
down the
squeezing
line.
by.
Exactly. But yeah, there's definitely a lot more flexibility and product offering south of the border.
Let's talk about a zero margin facility. This is a term I came across, and it's probably something that a lot of finance leaders are not aware of. And so, usually, to hedge a currency bet, you need to put up collateral, which ties up cash, and something that is that's something that startups hate, especially startups, but any business hates tying up cash for that's not actually working for the business. So, what does a zero margin facility do to solve that problem? And also, my understanding is that big banks don't necessarily offer this to smaller companies. So, what's the story with that?
Yeah, for sure. So a zero margin facility, it can be used in two different ways. It essentially functions as a bit of a credit for a client when it comes to let's just use the example of moving funds from one currency to another, so U.S. dollars to Canadian dollars. If you some brokerages out there that don't have zero margin facility will basically have wait 4 or 5 days for your funds to clear before they then convert said funds into the currency you need and then deposit back into your account. Banks are good for this because you're already banking with them. They already have your money on deposit. So they don't, there's no need necessarily for them to charge anything. Although sometimes you will see that even though the funds are being held on deposit, they might still hold some of them. So that's why typically when you log into a bank, you'll also see balance as well as available funds. So that could sometimes be a little bit hidden for some clients. But the main application of a zero margin facility is predominantly around hedging products. So looking at I'll use the example of a forward contract, for example. So if a business wanted to lock in a rate of exchange for a prolonged period of time, anything longer than 3 days is considered a forward contract. Up to the furthest typically you'll see on a brokerage and bank side of things is up to 5 years.
Hmm.
In order to engage in a forward contract, typically banks as well as brokerages will require a 5% deposit be held. So this is essentially a margin that protects said business should a client abandon a contract if the rates go significantly out. This is where you hear about margin calls. If a margin is significantly out of the money, you'll typically see a top up. But a new product in the market, essentially. That many brokerages are offering through partnership with their banking connections, as well as even organizations like BDC, for example, is what's called a zero margin facility, where it's basically you have credit applied to that 5%, 10% deposit. So you don't have to tie up any cash flow if you're interested in locking in a forward contract. So two of the vendors we work with to be able to provide services to clients essentially have a large buffer set aside to provide this product to clients. So it's something that we're able to, for instance, offer that has been a game changer, especially for small to medium-sized businesses. You know, if you don't have the adequate cash flow to tie up, tens of thousands of dollars for one of these contracts, then you might not be able to even go about hedging to begin with. But the beautiful thing about hedging is it's a way to eliminate some risk of your business. So it's a bit of a gamble if you're willing to for the businesses that do want to eliminate risk but have don't have adequate cash flow. It's a bit of a gamble about do I want to eliminate risk or do I want to be able to invest this money in other projects? And Yeah, you name it. So a zero margin facility at the end of the day is just a credit that's applied typically towards a deposit that might be required through a bank. And you hit the nail on the head there. A lot of small and medium sized businesses typically are required to leave a 5 to 10% deposit. Banks are typically willing to waive this for much larger businesses. And once more, I think that's more of an attempt to keep their business and kind of appease them. Or they have a significant amount of other deposits or products with the bank. So in a way, they're not, they're already kind of leaving sort of a deposit of sorts just through a myriad of other instruments with the bank. But yeah, it's been a huge game changer for any business that's interested in eliminating some risks in their business.
I almost feel like in the interest of balanced journalism, one day I'm going to have to get a banker from one of the big six on the pod just to kind of defend their position because we're throwing a lot of arrows at them today.
Fair point.
All right, quick pause here. I want to talk directly to the fractional executives listening right now. If you're building your practice in Canada and are not on the Fractional Pros Canada directory yet, you are making it way too hard for clients to find you. When I founded Fractional Pros Canada, the community, which now has over 1,000 members, fractionals across Canada, my goal was to create one central hub where business leaders could go to find talent like us. And it's working. And we have companies coming to the site looking for leadership, and I want them to find you. So don't stay on the sidelines. Go to fractionalproscanada.ca right now. Check out the directory page, and you'll see the link at the bottom of that page. If you're not on it already, it says get listed. Click over there, get your profile up, let the market know you're open for business. Fractionalproscanada.ca. Go do it right now. Get yourself more visible. All right, let's talk about the fractional treasurer role, Marc. Startups are notoriously bad at cash flow forecasting. They might have a big government grant, maybe a shred credit that's coming in quotes, soon. We never know exactly when, but they need the cash right now. So I see you offer grant and shred matching and also PO financing. So tell us a little bit about these two bridge options that help the company while they're waiting for the government check that's in the mail.
Yeah, for sure. So this is those are both. I should say the lending side of our business is a new partnership we've recently explored in the last few months. We've basically partnered with two lending marketplaces that have just made it a lot easier for small to medium-sized businesses to access the capital they need. Whether like you said, it's grant writing, shred, PO financing, bridge loans, you name it. The beautiful thing about the two firms we partnered with is it's essentially one application that's filled out that's then run through a gauntlet of 200 to 300 lenders, either in Canada or the US, depending on if you need Canadian capital or US capital. Which makes it a lot easier for you to go in through the system and simply say, this is generally what my need is. I have money coming in, but I need something in the short term. You'll get a mixture of some financing, some PO financing options, accounts receivable financing options, maybe even some short-term loans to even full-length term loans that might not have any early repayment penalties, so you can essentially kind of turn them into bridge loans. So there's a lot of opportunity to access products, and you can kind of, through that the platform that we've kind of partnered with, compare these options. There is a lot out there that people might not necessarily know to access, and that's one of the reasons why we went this route. There's so many products that could fulfill that bridge loan need of sorts. Rather than just a typical factoring or invoicing solution.
It's so good to know that these alternatives exist, because I think a lot of companies, especially the smaller ones or the earlier stage ones, they just don't have time to go and explore and learn about all these different options, which are not obvious unless you kind of go down the rabbit hole a bit. And a lot of them, I think, end up just, okay, I'll take that, 30-day loan at 12% or 20% and just move on with my day. And it's just good to know there's all these other options out there to consider.
Yeah, I mean, that was the idea around this, was just to make financing more accessible to small to medium sized businesses, because yeah, at the end of the day, it's, I always kind of equate it as, you're looking for a job, you have to go to 30 different websites, fill out their questionnaire about your experience, fill out this form, that form, attach CV or resume, and by the time you're done all that, it's, it could be 30 minutes to an hour per application. So the beauty of this is it's just one application. Um, you know, you attach what you can at that point in time, and then if you submit, it'll go to every single partner that would be of interest to you with the documentation you have attached. One of the things I also even recommended be used for is even a bit of like a health checkup, even if you don't think you might need financing right away. If that's something that might, be a need you suspect in the next 6 to 12 months, it's worth honestly doing one of these applications, because you'll typically come back, or the lenders will come back with a bunch of questions that you would need to at some point be able to answer if you did want to access lending. So it's a good way to just see what people are looking for, what they're looking at particularly, if there's anything about your financials, or just business in general that might be a sticking point later down the line. Yeah, that's one of the beautiful things of that system, because it is free to submit an application.
Yeah, and the big message not to be lost there is don't wait till you need it. Line this stuff up, get those accounts open, get those other financing channels open, so that when you need it, you're panicking, you're scrambling, you're going to be much less in a much worse position to start the whole process. So get it open before you actually need it, and kind of like the rainy day fund mentality.
Exactly.
Prepare. Yeah. I would imagine that your business, Mark, as not a bank, but more of a fintech, probably faces a little more skepticism from business owners, from CFOs who are concerned about doing business with you because you're not a bank, and especially in Canada, because we're so used to, we know a bank is rock solid. We know that
Yep.
as bad as their service might be, or whatever else, or their policies, or whatever else they're going to do to us, boy, am I going to get calls from the banks. Oh, I think my interest rate just went up.
Yeah.
But at the end of the day, we know that they're solid. They're not going anywhere. So somebody who's thinking of doing business like you, who's a little more risk averse, what do you do to mitigate that?
Yeah, so I mean, there's this misconception that, to some extent, brokerages and money service businesses follow different rules than traditional banks, but really we're all audited and held to the same standards. So in Canada, for instance, FinTrack is the governmental body that that oversees banks and money service businesses, financial brokerages, you name it. They set out guidelines and mandates that we all have to follow to a certain degree. There's also, whenever bank acts come out, those typically also can largely apply to some money service businesses as well. Most recently, we've seen something called RRPA. It's one of the two there, which is it's like Retail Payments Act, that basically was deployed over the last few years, just with some turbulence in the markets. The government decided, let's set a little more stringent regulations when it comes to the safeguarding of funds. That essentially goes above and beyond what's already mandated by FinTrack. So that's already come out, and the two vendors we work with are listed as some of the first few to have passed the qualifications to get that certification. So there's a lot of protection that goes into keeping up the standards that banks would also have to face. If anything, we do see most brokerages actually going above and beyond what's considered the minimum requirement, just because of our place in the market. everyone grows up with a bank account, is used to walking into a bank their whole life. I get it. It can be a little scary to look outside, but there's a lot of opportunity there, and a brokerage can be just as safe, if not safer, in some capacities than most major banks, just because of that need to kind of differentiate yourself in a very entrenched market.
When does a company graduate? I'll use that term in quotes, graduate to your service. Is there like a revenue threshold or a complexity level where a business owner is going to say, all right, using credit card or PayPal is no longer makes sense for us. What's the trigger point for a business to, for it to make sense for them to reach out to you and start a discussion?
Yeah, so I mean, there's a couple ways I can answer that question. The first being if depending on how exposed you are to the currency markets. If you're an e-commerce business and you predominantly sell to the U.S., and so you have 90 to 100% exposure to the U.S. dollar, and then all your operational costs are in Canada, then I would say no matter how big of a business you are, there's going to be an opportunity there for you to streamline things, from a couple $1,000s and up. Especially if you're finding ways to save 3.5%, if you're looking at potentially some hedging strategies to kind of allow for greater cash flow management from one month to the next. I would say any business with significant exposure, no matter how much they're moving, is a good candidate for the services that we could offer. For example, I would say as a step above the bank. Other than that, I mean, generally clients tend to come to us, once more, assuming they're not 100% or, closely, reliant on another currency. Most businesses tend to come to us when their FX exposure, I would say, is over 100,000 on a yearly basis. Because that's when the savings really start to make sense. I mean, we're talking about potentially thousands of dollars worth of savings on a yearly level. If you use once more that 2.5, 3.5% figure, that's what you typically see banks charging. A business doing $1 million or more is probably the sweet spot for where we can provide the most impact, because then you're talking $25,000, $35,000 savings on a yearly basis. In addition to the ability to now look into more sophisticated hedging strategies, depending on how big your exposure might be. We can move from forward contracts to options contracts, which can be a little more sophisticated. There's a lot more we can do as businesses get to a larger size. But I would say, honestly, if you're a business moving a few thousand or more on a yearly, on a per payment level, there's a huge opportunity to look elsewhere, where you can just be saving yourself thousands on a yearly basis.
And how do you make your money? Are there like fixed fees for services, or are you one of the guys taking part of the spread?
Yeah, so we don't have fees on our end for the vast majority of the services we provide. The only time you'll ever see us essentially with a fee is if a client uses us for same currency payments. We're not necessarily a payroll firm, so those CAD to CAD payments, for example, or the USD to USD payments, we will have a small fee for those. But otherwise, predominantly, we function based off a slight margin in the spread. So, depending on once more the size of the client we're dealing with, there's a lot of customization there. There's a lot of these more, I wouldn't say cookie cutter is the right word to use, but there's a lot of these online brokerages which basically have very defined, spread tiers that are, great for, beating the bank, which once more, is not necessarily the hardest thing at the end of the day. But there still leaves a lot to be desired for some businesses that might still be getting maybe more competitive rates here or there because of what we talked about before. They might have a friend on the inside, or someone, might be doing them a solid. But yeah, we essentially on our end can find a price point that essentially guarantees savings that are worthwhile on their end. And that's because the nature of Pulse is we're an advisory first firm, so we spend time getting to know the ins and outs of our clients' needs, where the pain points are, how they're making payments, how they're receiving payments. There's a lot more that goes into FX than just trying to get a better rate as well at the end of the day. Actually, just on a little side note, I can tell you another talking point that I was just speaking about this morning with a client, and this is something that people might not know to look for, but it's essentially a client paying a manufacturer in China. He was consistently paying them in U.S. dollars, as is historically the norm. Although U.S. dollar being not necessarily the main currency of China, the renminbi would be. I asked him a while back to do some research there with his manufacturer, just to see if he did the conversion from CAD to renminbi rather than directly to the US dollar, and we found out he was actually getting charged an extra 5% markup
Wow.
for his US dollar payments rather than paying in the local currency. You'll see this honestly time and again with various vendors, especially if you're a Canadian business paying a vendor in the US. A lot of vendors will accept Canadian dollars, but usually because they're then willing to take on the currency risk, which they would only be willing to take on if they bake in a bit of a buffer on their end to kind of protect themselves. And that, I've seen as high as 7.5% in terms of buffers be placed. I'm not saying this is always the case. Sometimes, it will be one for one. It won't cost you extra, but it's just another good talking point. Another thing we advise clients on is doing that level of research into what's possible. Asking the next time a bill comes up where you're paying into a country that in a currency that isn't necessarily the local currency, just seeing if they can bill you in both, whether it's U.S. dollars and renminbi, or if you're paying into euro, whether it's paying in U.S. dollars or euro, for example. That's another area where there's not a lot of transparency because it's pricing is dictated by the vendor or the manufacturer. But it's something that could once more easily day one save you 5%. Yeah.
So let's double click on that advisory service that you offer. So, and dig into a little bit more how you play in the sphere of the fractional relationship. So if I'm a fractional CFO, I want a partner who's going to make me look good with my CEO, right? He's going to help me work some magic. So walk us through what that perfect partnership looks like. How do you play with the CFO? Are you sitting in on monthly strategy calls? Are you helping that fractional CFO forecast risk so they can go to their board with confidence? What are the things that you're doing typically in that kind of relationship?
Yeah, for sure. So on the more involved side of what we do, and I should also preface, I mean, we can be as uninvolved or as involved as clients want us to be. But on the more involved side, typically when we first initiate, conversation with, said fractional CFO and a client that might be in need, we'd like to do a bit of a historical undertaking. So we'll look at maybe past transactions, whether it's, the last couple or going back about a year. Just to do some historical comparisons on rate, just to get an idea of roughly what they're being charged by their bank, for example, on their FX conversions. Then we'll typically look at other sources of payments, whether or not they're using a Canadian credit card, for example, to fund subscription payments in USD or to pay vendors in US dollars. We'll look at it, are they using any other payment processing system that's doing the FX or conversion outside of their bank? So there's a lot we can look at to see what their overall exposure is compared to just looking directly at their FX needs that they're currently undertaking from, let's just say, their US account to their CAD account. There's just a lot of sources where FX could be happening that I think is lost on a lot of businesses sometimes. Then we'll also look into, how exposed are they to certain markets? What's the nature of their business? Some businesses are great candidates for instance, for forward contracts. I mean, depending on what their payment terms are and with vendors and when they might get paid by clients. I have one client that basically they import machinery from Europe, and they sell it to Canadian businesses, and they'll essentially agree to pricing up front for how much to charge the Canadian business. But they typically would only pay a deposit upfront with their vendor who's making said machinery. And then when the machinery is ready, let's just say that could be 90 days from now, 6 months from now, a year from now, that's when they'll go and make the final payment. Now, if you look at how much they invoice their client, a year ago versus how much that machinery costs now, you could see a wide difference. The client could potentially have gained based off the exchange, or now their margins could potentially be in the negative, and now it's costing them money. So, to not have an awkward conversation where you go back to the client and say, "Hey, I know we agreed and signed the paperwork here, but I'm going to need more money from you." A forward contract is perfect there, because when a client signs that contract, you know exactly how much it's going to be that day for that piece of equipment. You can lock in that pricing, and that allows you to just set and forget. When that machinery is ready and you're ready to make the payment, you've already locked in the rate. You already know, and I've already agreed with the client how much they need to pay. So you collect their funds from the client, you go and make that payment, and you collect the margin that you already established when you quoted that invoice from day one. So for some businesses, that's a great tool. It allows you to once more not be exposed to the FX market. It allows you to properly allocate cash flow now on a monthly basis. You're not having to create maybe a much bigger buffer just in case, because you never know where the markets are going to go. You can run a little leaner. So we look at industry examples, case studies that could be applicable to a client, and then we also help plan these hedging strategies for the client. And there's many ways to go about doing that without getting into far too much detail. What I told you is just an example of here's one forward contract, but depending on how exposed you are, sometimes clients will do what's called a rolling hedge or a layered hedge, where they'll book forward contracts, let's just say every month for 3 months out. So then they have a number that they can work with for those time periods, depending on once more the nature of their business. That could go out longer or shorter, but it allows them to whenever they speak to a client to quote on something, to have a rough idea of what they'd be dealing with at the end there.
All right. This has been fascinating, Marc. I've learned a lot. I think we've accomplished two big things today. We've pissed off banks, for better or for worse. But more importantly, we've uncovered a lot of different ways for businesses to save some money, cash flow crunch options. So I feel a lot smarter today, and clearly a guy like you seem to be very passionate about this, and you live and breathe this stuff. So a good guy to know, a good guy to add to the Rolodex for me. So thanks for being here. I want to finish off with one last question. If you could put a message on a billboard for millions of business owners, CFOs, maybe even bankers to see as they drive by that billboard on the highway of life every day, what would you be putting on that billboard?
Great question. I mean, I would say it's more so, don't treat FX as an afterthought. I mean, there's just so much you can do in the FX space, and it's, at the end of the day, I would say the tagline would be, it's not all about rates. There's so much strategy that can go into it beyond rates.
It's not all about rates. Okay, that's deep. That we could dissect that for hours. I love that. It's not all about rates. Yeah. All right, Marc, thanks again so much for taking time out here and sharing with us on the Fractional Pros Canada podcast.
Anytime. Thanks again for having me, and I hope to catch you around again soon. If you're in Toronto, hopefully we don't get locked outside of a bar again, but
Hopefully not. Maybe this time, if we do, we should maybe BYOB just in case.
Yeah, fair point.
All right, Marc. Thanks again.
Anytime. Thanks again. Appreciate having me.
That's a wrap on another episode of the Fractional Pros Canada podcast. If you're a fractional professional based in Canada, we'd love to have you join us in the Fractional Pros Canada Facebook group, the home for Canada's fractional community. It's where Canadian fractional executives connect, share insights, and help each other succeed. Until next time, I'm Robert Mendelson, Fractional CMO. May your impact be full-time, even if your hours are fractional.